Well, everybody, today is October 19th, and yesterday the SEC released a report, on the GME saga from January of 2021. And I wanted to cover that report in detail today. There's a lot of interesting information on market structure, gamma squeezes, short stock. And to do that, to help me out here, I brought my friend Renato on.
My name is Renato. I trade full time. I am a contributor here at SpotGamma. In addition to that, I'm a reporter at Benzinga, so I'll mainly cover developments in finance and technology. You can see my Twitter right there.
So we want to start off here by just providing our overview of what happened back in January of 2021. You can see this analysis on our website, spotgamma.com. And we would just say that the SEC report didn't really change much in our view. They added some great data and quantified some of the things that were happening. But basically, the way that we saw it is in early January of 2021, and even towards the end of the fourth quarter, it was clear that retail was getting involved with GameStop. The stock started to get bid up. It had doubled in price in January. It was quite a move. Call options really picked up, and that was the initial move higher. You can see on this chart. We have some other charts to support this later, but the price really moved up, and call options, the foundation of the squeeze, really picked up there in mid-January. And then in towards the end of January, that's when the Elon Musks of the world started getting involved in the tweeting. Social media is going crazy. It was front page news of all these newspapers. And consequently, in just a few short days, the stock went from around $50 a share up into the 300s. Now, it's at that area, end of January, where the implied volatility of the options went crazy. The stock price went, obviously, as I just mentioned, up around 300, and options got very, very expensive. And we think that the baton was sort of passed from the retail trader to the investment professional, sort of volatility funds and the like. And the other interesting thing that happened at that point is there became this credit issue with Robinhood, right? And I don't think it was just a credit issue with Robinhood, but retail traders, they had to come up with some funds, to buy shares of stock at $300 a share. And there was a lot of what's called failure to delivers. And I know, Renato, you had kind of a similar view on the report that the one thing that sort of came clear was there are some regulatory issues that the SEC seems like they're going to want to address.
Yeah, so I do think a core focus, I guess, was the popularized brokers, the mechanisms like payment for order flow, the gamified user interfaces, and some of the behind-the-scenes settlement things that happened, the risk management of the clearing agencies, and how that ultimately resulted in brokers imposing these synthetic supply imbalances, right?
So with that, let's kind of start to get into analysis. We're going to break this down into a few pieces here. First is
Mhm.
obviously we're going to talk about the huge segment, the huge number of new participants. We're going to talk short stock, the gamma squeeze, move into the broker margin call, and then finally touch on some interesting market structure notes as Renato just touched on. So the big news obviously was just the activity in the stock. Now this is actually the volume traded in the count in the end of Q4 of 2020, and I included this slide. These are all slides primarily from the SEC. We'll point out when they're SpotGamma slides. But the activity really did pick up and spike in Q4, as you can see here. So that retail framework was being put in place, for a couple months, obviously before the January squeeze. I think a lot of people feel like the squeeze kind of came out of nowhere. And this chart gives a little context that things were percolating, obviously well before the January major squeeze, so to speak. And with that, another thing we just touched on, Renato, is that the number of accounts coming in exploded. I mean, it was meme mania. Everybody, you talk
Yeah.
to across all walks of life were getting involved in this. The SEC says that the accounts traded per day went from 10,000 beginning of the month to 900,000 at the end of the month. Just so much activity there. And the other interesting thing, I think you caught this as well, Renato, was that Robinhood reported that the average customer is 31 years old and their account balance is only $240. Now, we're not going to
Yep.
point a finger at anyone who's young that wants to trade. By all means, get involved. But that is a small account balance when you're talking about a stock that
Yeah.
was $350 a share, right?
Yep, yep, for sure, for sure. Going back to the speculative commentaries, right? You had those online forums on Reddit, like Wall Street Bets, that was kind of blowing up. You had mainstream television covering all this, and this was all into the price rise. But there wasn't a lot of kind of focus on, I think, at the outset of, some of the underlying things that are going on in terms of institutions trying to take advantage of some of the dislocations and momentum that we were seeing, right?
Yeah. So, and I also I think that was sort of a clear thing. I mean, people knew obviously how the globe was really getting involved there, but to quantify like the SEC did here was really pretty interesting. And the more people trading was great for Robinhood, great for payment for order flow, great for dark pool trading. They're capturing the spread, right? The market makers are in bid and ask, and so I think this was by and large a pretty successful event for market makers and brokers, even though there was that liquidity call with Robinhood. And sort of on that point of the spreads, this is a great chart here that shows the nominal and effective spread. So this is the bid-ask spread of the stock. And obviously, the wider the spread, particularly when people are trading a lot, the better it is for market makers, right? They're going to capture that spread because market makers are on the bid, they're on the offer. And when you cross that spread to trade with them, that is money in their pocket. And when you consider how wide this spread was, along with how much volume there was, I think it was kind of a boon for the Citadels and the like.
Yep. Yep. 100%.
So one of the things that was kind of most interesting to me was that the SEC essentially said there was no real squeeze, right? Short stock was not really part of it, and they basically said that the gamma squeeze wasn't involved. And I personally took a little bit of issue, or I saw that differently, I should say, respectfully to the SEC, that I see this a little bit differently. So let's talk about some of the data they presented and where we see some differences.
Yep.
First they talk about the short interest as a percentage of float. This number here, where they say GameStop, shares of float were 125%, which was obviously far and away, the largest amount of all those sort of squeeze stocks in terms of, float percentage. And then they sort of move on after they say that the short interest was extremely high, the highest of any stock. They move along to say that the staff believes that the hedge funds broadly were not significantly affected by investments in GameStop and other meme stocks. Obviously, the famous one was Melvin Capital, right? And Andrew Leff was involved in there as well in terms of being demonized for shorting the stock. But it seems like what the SEC is saying, outside of really a couple of funds, it wasn't a big P&L moment for many funds.
What I saw, or the thing that popped out, was the report was kind of talking about how, the run up in GME stock price coincided with, buying back of those short positions, right? But ultimately, and I think the quote was, buying was a small fraction of overall buy volume. So
Mm-hmm.
ultimately, resulting in those reports creators to conclude that, underlying motivation to buy volume cannot be determined, right?
Right.
Yeah.
And the fall off in the short interest, was really remarkable to me. I mean, you can see in just a few days that short interest was just completely wiped out, and that was, there was a lot of obviously issues with capital, and I think a lot of other brokers were trying to close down short interest. People wanted to cut risk off this GME squeeze, and the other meme stocks as well at the end of January, and so I think that just closed down a lot of the initial trades that we saw.
Yep.
One of the other slides in regards to the short selling too was the fact that they didn't see much what they call short seller buying volume. So, there's a lot of
Yep.
buying volume from just traditional accounts, traditional long players, retail and the like. And they categorize this as short seller buy volume. Now, they didn't really provide much detail into how they categorize short seller buy volume, but their point here is that if you look at sort of this pink salmon colored area, these are essentially short coverings, and their sort of view was that, look, we didn't see much short covering at any point, and so that must mean that short buybacks weren't a big part of the squeeze. And I have really 2 points on this. One, some interesting stories at the time about XRT, which is an ETF, and I think we have a slide that mentions this later, but GameStop became 20% of the weight of that XRT retail ETF. And so what people were doing was they were taking delivery of the basket, right, of XRT just to get the GameStop shares. And they would then own the shares by buying XRT, and they could essentially, cover or get short covered shares through that XRT ETF. I would also note that if you're long or short options against these, short shares, you can let your options expire, right, and that will call away short stock, right, or long stock. So there's a couple of different ways that people could be really trading that activity. I mean, I just bring it back to here is that this short interest clearly cratered at the end of January 2021, but they don't show any buyback volume there at all. So where did the short interest go if there was no buyback, right? There had to be another mechanism for people to remove those short shares.
Yep.
The other thing that SpotGamma really dig into is this idea that the SEC said there was no gamma squeeze. And there's an interesting sort of semantics in that, right? They don't say options were involved. They say it wasn't a traditional gamma squeeze, which for most of us who talk about gamma squeezes, you talk about a lot of call buying. The call buying brings in dealers who must buy the stock as the stock goes higher. So on one point, they say that the gamma wasn't involved, but they go on to mention how large the options volume was. So in this case, they say that the customer flow increased. Now, customer can be a retail trader or a hedge fund. The customer flow increased substantially from 58 million on January 21st to 500 million on the 22nd, and peaking at 2.4 billion dollars. That is the option daily trading volume. So, these numbers are really pretty incredible. Those are just unbelievably large numbers. And they are careful here to note that it was an increase in the buying of put rather than call options, which is something we're going to talk on in a second. So what they note here is that it's the buying of call options, but when they show the options dollar volume over here, it really looks like it's call volume that is massive, right? I mean, that's what I tell you when you want to look at this chart. So they quantify the amount being traded. They show it on a chart here, but then they sort of point out that it was an increase in put, not call options, which seems to go against whatever this chart here displays. And they further say that based on dollar volumes, the increased trading concentrated heavily in call options. So that kind of goes against the prior statement that it was put options. And a large percentage of those, and this is the key term or the key area here, a large percentage of those were very short dated options, and implied volatility rose dramatically. So implied volatility you can think of as the cost of options. And they show a chart here, which is the implied volatility of 1 month options, which is red, and then 3 month options, greens, and then the equity price. So what was happening was at the time, traders, particularly in the early part of January, traders were piling into very short dated call options, and you can see here that the implied volatility really spiked. And that was the initial squeeze, right? The mid-January squeeze that we talked about at the top of the presentation here. And when implied volatility spikes, that means that the price of options is spiking. So for implied volatility, in this case, to get up over 500-600 is a massive, massive implied volatility. And that also tells us that the price of options is really high, which can really limit who can get involved, right? Because the cost of the option is so high, the average account, is down around $240 on Robinhood. Those Robinhood traders, when implied vol is 600, those people are not trading options at that point. Now, they may have bought options that they're holding, that tripled, quadrupled, 100x in value, right? But they weren't actively trading those options if slow margin levels. So just to quantify this again, Renato, this plays into the capital call we mentioned and the delivery issue. If you break down the actual cost of options, right? We have this on this chart. This is something that we have on our blog at SpotGamma. This breaks down the cost of a at-the-money option by percentage value of the stock, right? So if it's a $300 stock and the at-the-money option is 10%, then the option costs $30, right? So the cost of the option as measured by percentage value of the stock skyrocketed as the price of GameStop skyrocketed. So you're talking about at-the-money options costing 30 to 40% of a share of GME, and that was when GME was up around $300 a share, right? So when you're talking about earlier in January, the implied volatility or the cost of the option was 5% of the stock, and the stock was trading around $20. So now you're talking 30% of 300, it's much bigger numbers, right? So that really had to limit who could get involved at the end of January. And further to this point, we did an extensive analysis. You can see the link here, spotgamma.com/GME squeeze. We'll put this in the YouTube description. But what's most interesting is the open interest. And this is why we believe that it was initially a call gamma squeeze. You can see the open interest in calls in mid to early January. This shaded blue area grows dramatically right in the middle of January. And then towards the end of January, the call volume doesn't grow as a percentage, right? The big increase in open interest is puts. And that is exactly the time that the stock goes crazy high, implied volatility goes through the roof, and it's a different type of trader comes in, right? The sophisticated guys were selling put options and directionally hedging themselves in other ways. The put implied volatility, there's a lower bound, obviously, when you buy a put, right? A stock can't go below zero. So you have a very clear risk reward there. And when the options are so expensive, it offered a lot of padding to selling those options. Whereas on the upside, when you short a call, you have theoretically no upper bound, right? The stock could go to an infinity squeeze, as a lot of these guys would like to do. So it's very, very clear that yes, as the SEC mentioned, puts were heavily involved, but those puts, our analysis showed, and we looked at it transaction by transaction, those puts were being sold, right? And so this is a key distinction of the gamma squeeze. Technically, you could make an argument that the later half of the squeeze, end of January squeeze, was not a gamma squeeze, but more of almost a delta squeeze. Gamma squeeze, certainly here in the beginning of January, calls were getting bought and the stock was going up. You have a short squeeze combined with the gamma squeeze. That is the reflexive mechanism to keep the stock going higher. But when you sell puts, you are actually forcing dealers to buy stock. So we put a little example of this here just to explain this. If a trader comes in and he sells one at the money put with a 50 delta, that means that the options market maker is buying that option. So the option market maker is now long a put, and that put would have a negative 50 delta position. So the way that you would hedge that position out is by buying 50 shares of stock. Now, if you extrapolate that, right, to all these people selling puts and getting involved with puts, you can see how that could be a pretty large amount of stock to buy, right? You can see how
Yeah.
that would work in and help support the price of GameStop. And again, you can read more in depth about this on spotgamma.com at this link. Okay, so we wanted to segue quickly using this chart that we found from Unusual Whales. It shows the 13F filings for Citadel, which is essentially a way of looking at their positions. And we're going to use this to segue into some of the market structure conversation. But basically what it shows is that obviously Citadel has a very large call and put position. Now we believe that those are a lot of long calls and long puts, probably a pretty good blend on the call position. Obviously in January, they were probably starting off short calls. People were buying long calls for the gamma squeeze. And then once vol came, got to 4, 5, 600%, we think a lot of people started selling call options, which allowed Citadel to get long. So the bottom line is they're collecting a ton of spread. They have a huge options position, and they are internalizing tons of order flow, meaning that the order flow coming into Citadel as a wholesaler means that they are the liquidity in the name, right? And they're getting a ton of data and information off of the way people are positioned, and it allows them to better monetize the flow. To that point, we note that the SEC says the vast majority of GameStop trades were internalized, about 80%, as opposed to executed on an ATS like a public exchange. And Citadel was accounted for about 50% of that internalizer dollar volume. So they get all the flow, they keep it for themselves, and they are the liquidity in the stock, right? They know more than everybody else. They have a bigger position than everybody else, and they have an edge, in my view, and how to trade this thing because they know exactly how people are positioned.
I think you hit the nail on the head. Who are some of the other large counterparties involved, right? Virtue
Yeah,
and
Virtue is a big one that comes up, quite frequently. They're actually a public company. You can look them up. I think their ticker is VTS. But you can also find, Wolverine, Susquehanna, Jane Street. These are some of the other players that are active, obviously, in trading. A lot of them trade both the stock and the option as market makers because obviously there's a lot of synergies, with doing both. But there's not really that many of them, right? They note here that just three wholesalers really accounted for 88% of the volume. Liquidity is really concentrated. If any one of those counterparties had a credit problem, and we know of none, we're not saying there is, but just imagine if one of them did, that could really hamstring the market, right? So this gets into the kind of the meat of the report, right? We obviously had some issues with the SEC, excuse me, saying there was no gamma squeeze, but their notes on the margin calls reinforce some of our theories and ideas about what sort of capped the squeeze. A lot of people thought that Citadel called Robinhood and told them to shut this flow off. There's some speculation that maybe there were some conversations back and forth, right? But at the end of the day, this all seems like a credit margin issue. That is really what this boils down to. So we'll just read off this slide here that they say on January 28th, the mania hit its crescendo on the back of a short squeeze of the record books with about $359 million worth of shares were caught in limbo. So one of the things that the SEC doesn't mention is this failure to deliver. I mean, they make a quick mention of it, but they don't quantify it like Bloomberg did here. And what this is, and Renata, maybe you want to touch on this a little more, is that if I buy a call option that's in the money, when that call option expires, goes into expiration, if the call's in the money, I'm then responsible for buying GameStop stock, right? If I buy, the stock on margin and there's a margin call, I have to come up with the extra money to purchase that stock, right? And they don't really make a mention of this, which to me absolves retail of a little bit of the responsibility, in my view. So when you have this failure to deliver, Robinhood or the broker is on the hook for those dollars, right? Because another broker who's transacting, with Robinhood's customer is looking to sell or buy shares, right? They want to send the shares over. So that creates problems in the plumbing system. In response to the market activity during the trading session, the NSCC, which is the National Clearing Corp, made intraday margin calls from 36 clearing members totaling 6.9 billion. So we're all aware of how Robinhood was kind of the most famous one here, got this huge margin call at the end of January, and JP Morgan and some others had to deliver them some capital. They didn't have a problem getting the capital raised, but it's clear that there was this funding credit issue. And if something didn't happen, right, that could really cause some problems again in the financial system. And it's interesting to note here that Robinhood gets a margin call based on their risk, just like Robinhood could deliver a broad margin call to me based on my portfolio risk. So Robinhood's margin call, got ratcheted up, and they didn't have the liquidity there, right? And I think that speaks to some of the probably lack of risk management that Robinhood had. They've been hit before for not having the best risk systems in place. If you can Google, you can find some past instances where they had other problems in this area. So it's clear that this was not a Robinhood trying to deal with Citadel or make a deal with Citadel to sort of stop the squeeze, right? I think the volume was incredibly profitable for all of those guys, but so simply Robinhood got a margin call, right? And that's really what kind of capped the event.
Yeah, no, again, hitting it on the head. And I believe Robinhood themselves, they said that it was like a five sigma event, like
Hmm.
basically beyond expectations, right?
Yeah.
And they were just kind of forced into that situation, right? Where, due to that risk management of those clearing agencies and so on, that ultimately resulted in brokers like Robinhood putting these stocks in position closing only status, and that created synthetic imbalances, and forced or resulted in a move lower in share prices, right?
Yep. And sort of
Yeah.
to that point, the clearing fund here, they note in the SEC notes here that they have this volatility component in their risk models, and they want to make sure that there's a 99% confidence level in that risk metric. And this, as you said, five standard deviation event, it may have violated that 99 percentile confidence, right? I mean, sort of depends on exactly how the thing is calibrated. So, this caught a lot of people off guard, and I think the more conservative brokers, right, were a little bit better positioned for it. But at the end of the day, everybody made it through, right, and probably made a lot of money on the brokerage side. They all, made a lot of money because of it. So let's just shift in sort of the last few points here. There was some key little tidbits in the SEC report that could spark some interesting things. And as you mentioned at the presentation here, that the key takeaway, and it was for me as well, is that the SEC seems to want to hone in on two things. It's market structure, meaning payment for order flow and liquidity issues around that. And then the second one is the gamification of these broker systems, right? Confetti
Mhm.
shooting through the sky when you hit buy and those types of things, right, are clearly under the microscope at this moment. And so to that point, we know, less than 60% of overall equity volume is typically executed on exchanges. So that means that 40% of total volume is in dark pools and off exchange, where a lot of the trading public can't access it, right, directly. And then another sort of similar point is that they brought up this idea of market makers in the option space. When they are receiving this options order flows, they're very careful about which exchange they place that order flow onto, so they can take advantage of rebates and the like from the different exchanges. So there's some, not gamification really there, but the options liquidity has to end up on an exchange at some point. Whereas in the stock side, they can internalize that order flow. They can put what's called a print up on an exchange, and they don't ever actually have to trade the volume on an exchange, right? They can sort of internalize it, as mentioned before, which means the average trader can't ever interact with that stock flow. But on the option side, those options orders must show up on an exchange. So there's a little bit of a different there. They also do this thing called segmentation. Now, segmentation is they split the order flow into different buckets depending on where the order flow is coming from, and they offer different payment levels on the options order flow side, the payment for order flow side, depending on who the retail or who the client is, right? If it's retail, the payment for order flow will be quite large, right? I might pay you 50 cents per contract. for the retail order flow. But if it's an institutional hedge fund flow coming in from like Goldman Sachs, I'm probably going to pay like maybe like a nickel for that flow, right? So that's the customer segmentation. And obviously, when you segment the customer order flow by retail or institutional, you're going to want to interact, right, or trade against one set of that order flow in a different way from a like a sophisticated hedge fund, right? And so they note here that the segmentation is an issue, but also the payment for order flow itself, because when Robinhood or someone else gets paid for that order flow, they could issue a rebate back to the customer, right, and give them a better trade price, or they could keep all of those funds for themselves. And that is up to the discretion essentially of the broker. And you can see how that could be, there can be some nuance, right, or shades of gray in terms of the conflict of interest there. These practices, as I highlight here, overall, these just bring up a bunch of issues with the way that options and stock orders are flowing. And then we also note here, this is the issue that the SEC raised about the novel effects of digital engagement practices. This is the confetti shooting from your screen when you buy a stock. The SEC seems to be having some issues with that.
Brent, correct me if I'm wrong, but some of these mechanisms are in terms of like the order flow, those sorts of agreements around those, payments for order flow, are those are kind of agreed upon early on, right?
Yeah, so each one of these individual wholesalers or market makers, intermediaries, whatever, will approach brokers directly. There's salespeople that reach out to Robinhood, and they all sort of position themselves to offer the best deal to Robinhood, right? We're going to pay you the most. Yes, best execution matters and the like, but really it comes down to trying to win Robinhood's order flow as a market maker, right? Part of it is how much flow can you handle, but how much are you willing to pay for that order flow? And then you set up an execution agreement, between those two parties to, outline exactly how all of this is going to work. So it's not just payment for order flow. There is, how much order flow can be sent to the various brokers.
Yep.
A smaller market maker may not want to take down as much trading as a Citadel would, right? There's obviously some best execution pieces in some of this, but at the end of the day, these are private agreements made between these two entities, right? The broker and the wholesaler or market maker. And as far as I know, the explicit agreements aren't made public. That we are going to close this presentation. We hope that you found a lot of valuable information in here. If you want to learn more about our original analysis of the GME Gamma Squeeze, you can head over to SpotGamma.com. At SpotGamma.com, you can also sign up for a free 5-day trial of our market analysis service. We also offer users the ability to view the options position on over 3,500 different shares. If you have any questions or comments, please leave them in the description below or send us out a message at SpotGamma on Twitter or info@SpotGamma.com. Renato, thanks for joining us. You want to let people know again how they can get a hold of you?
Yeah, so the best place to kind of follow up with me is on Twitter at RENATOLCAPELJ.
Great. Thanks again for joining me, Renato, and we'll talk to you soon.